Good morning, Flo.
Good morning.
Good morning. Fed day. Woo! Usually a day when we sit picking our noses until we get to the hour. And it looks like we've got some moves to be getting our teeth stuck into today. How are you, still all right?
I'm very well, thank you. Been busy all morning, so I don't know what's been happening in the market, so you will have to enlighten us.
No, I'm not telling you. We're going to talk about the weather. Yep. So
how are you? Everything all right?
Yeah, all good, mate. Hectic couple of days. I'm busy this morning. I haven't stopped this morning. It's getting like that, isn't it? Non-stop stuff going on.
Yeah.
But yeah, such is life, as they say. Such is life. No K-Man today. He's got a day off, some jobs to attend to. So just me and the big man, still. The little big man.
Big man. I'm not sure about that, but yeah.
Right,
stuff.
Let's crack on then. We will kick off over at the RBA, and Lowe came out and said that further tightening of monetary policy may be required. They're seeking to bring inflation down in a reasonable time frame. Services and energy inflation is high and will likely remain so for some time. He said the board had a strong consensus to raise rates. So there's obviously no pressure after the RBA the other day. So these are the first comments out from those bods. RBA's Kohler said that the strength in population growth is a big change for our forecasts. A fast recovery in population could have unanticipated pervasive effects. Higher demand for housing has pushed up rents and seen prices stabilise earlier than expected. So that's forming part of their thinking at the RBA in regards to monetary policy. And as we've been mentioning previously with other central banks, the housing market, and in this case, the population, might be a driver of future price rises to come in that sector. So one to keep an eye on over there in Australia on the property front. Moving on to the RBA's June meeting, and Reuters ran a poll of their pencil pushers and economists, and 25 of 29 economists said that the RBA will hold rates at its June meeting. However, they expect the RBA to raise the cash rate to 4.10% sometime in Q3. That was the medium forecast for that. So economists expecting the RBA to hold next month and then maybe hike again later on this year. Who knows with these lot. Just looking at a bit of data coming in that we got overnight and this morning. Let's get down to it. We'll cover the US stuff from yesterday in a bit. Kiwi had some employment data coming out. The employment change looked healthy, 0.8%, beating expectations there. Employment rate was expected to tick up, but remained at 3.4%. Labour costs over there in Kiwi land ticking up a bit, not as high as expected. Year on year, 4.5 versus 4.6 expected prior, 4.3 on the quarter. Still a gain, but not as much as expected or the previous quarter. Over to, I think there was some Aussie data this morning as well. Let's have a look. There certainly was. So some manufacturing indexes not looking too good, and construction not looking too good over there. Not huge numbers as big as the PMIs, but certainly worth noting. Services in Australia looking perky, 53.7, beating expectations and moving firmly into expansion once again. Again, we're seeing this divide between manufacturing and services. Retail sales coming in a bit better than expected, 0.4%. So things ticking along over there as well. Over to Europe, Italian unemployment came in at 7.8%. The unemployment rate there was expected to jump to 8%, but it came in lower than that and lower than the month before. So good jobs numbers there, or strong looking jobs market there. Same for the Eurozone number, an improvement there to 6.5% from 6.6. And look at that, even Greece 10.9% from 11.3% there.
Yeah,
Still
baby.
firing away over there, mate.
We are trying. We have,
trying.
very important elections coming up this month, and for people who follow Greece, it's hugely important to continue. I mean, the past 4 years we've had a big recovery in the economy and everything. So, fingers crossed.
Yeah. When is that election, mate? We should probably note it down.
2 weekends from now.
Okay. So that'll be the 28th, something like that.
Let me check. No. This is going to be the 21st, Sunday the 21st.
21st.
So is that 3 weekends from now? There you go. It's 3 weekends from now then.
Yep, cool. I've stuck that on a post-it note to remember to have a look at that one when it comes up. Now, things may be looking better in other countries, but not in Germany, according to their Chamber of Commerce, because they've cut their forecast for real growth of German exports for 2023 to 1% versus the prior forecast of 2.5%. That's been backed up by the Industrial Association, the VDMA, who reported that Q1 engineering orders are down 13% year on year. And that's been made up of domestic orders down 14% and foreign orders down 13%. For March itself, orders were down 6%, and in that, domestic orders were down 10%, foreign orders down 4%. So the big manufacturing machine that is Germany not posting some good numbers there. Probably explains a good reason why we saw negative growth in their first GDP reading from those guys. Over to the US, we did get some data yesterday, factory orders and durable goods revisions, which we'll take a quick look at that if I can find them. Where are we going? There we go. Down there. So factory orders coming in positive, but not as much as expected, but turning around a loss from last month. However, you take out transportation stuff and it's a negative. So that falls in within some of the durable goods numbers, some of those big ticket items we've spoken about before. Not too great a difference on the revisions for durable goods. But there you can also see jolts, those jobs numbers, coming in lower than expected. So continuing to fall and move under that 10 million mark that it's been sitting above for the best part of 2 years. So that's got the market a little bit antsy about the upcoming job numbers. It's not a direct lead into the NFP because this data is for March. And obviously that's a couple of months behind what we're getting, or a month behind what we're getting from the NFP, which is April data. But still, that's a trend that we need to keep an eye on, because if employers or firms are drawing down hopes of hiring people, that's going to have an impact, and in one effect it will perhaps tighten the labour market even more, because the drop in jobs openings doesn't mean that employment's going to fall. It just means the market might get a bit tighter, which can then have wage pressure issues, because if there's less jobs to look for, there's a big scramble to get them. So need to keep an eye on that one as well, all part of the puzzle as usual. On that JOLTS number, and they don't usually show the breakdown, but within that, the quits number, which is a number I look at to show whether people are trading up jobs, moving on to higher wages, moving up the ladder. That came in at 3.851 million versus 3.980 million prior, so a little bit lower. That was running at just under 4.5 million this time last year, so it's down a good chunk of what it was last year. On the layoffs front, that rose to 1.8 million from 1.55 million previously. So layoffs are ticking up there as well. So potentially on that side, there's some softness coming into the labour market from there. After that data, Fed swaps were pricing a bigger decline in rates from where the expected peak is supposed to be. So this trade, the pivot trade again, looking a bit steeper in how much they'll cut rates when the Fed decide to do so, at least what swaps are pricing. And speaking of Powell and the FOMC today, a bunch of US lawmakers wrote a letter to the Fed urging Powell to halt rate hikes. Among them was his arch nemesis, Elizabeth Warren, who hates him with a passion. That came...
There's also long bonds, right?
Sorry?
There's also long bonds or something.
Yeah, you don't know what what those clowns are trading, but yeah, Warren is not a fan of Powell by any shape or form. But economists at the White House also said that Fed's hikes to reduce inflation are having a negative effect on the banking sector. So why would we add to that? So also a little nod about further rate hikes to Powell and co. Though I'm not sure what she was going on about, stating the bleeding obvious there. That's what they paid them the big money, I suppose. Who would have thought they'd have a negative effect on the banking sector, raising rates? But there we go. Over to the other political football, which is the debt stuff. And apparently WSJ reported that House Democrats are going to try and force a vote on a clean debt ceiling. This is one of the political plays they can do. I don't really understand it fully, but they can submit a petition or something that only needs a minimum amount of Republican backing for it to hit the floor and go for a vote. But it's just one line they're potentially going to try and push to get something done. US Senate Majority Leader Schumer said that the Democrats will wait until the 9th May meeting of all the leaders before deciding whether to move forward on a clean debt ceiling bill. They want a full 2-year debt ceiling extension rather than a shorter term bill. So just bringing everyone up to speed, there's a few ways this can go, but two of the main ways that are being looked at is a longer term can kick and a short term can kick, maybe of a year or 6 months, something like that. If they can't get anything done right now, then an option is to kick it for a few months down the road. The bigger plan seems to kick it to maybe a year or 2 years down the line. So that's where we are at the moment, what's expected. Of course, none of this stuff is moving towards actually resolving reducing debt properly. It's just about, as usual, kicking that can as far down the road as they can, so they don't have to worry about it until the next time. So that's where we're at with that. Not too much on the headline front today. We are going to have probably a quiet day while we get into the Fed. Stel, did you have anything, any snippets you want to throw in for me?
News-wise, no, not really. I mean, obviously, yesterday the market-moving headlines were about regional banks being in trouble again, or apparently, the whole banking crisis rearing its head again. But apart from that, you covered pretty much everything. Nothing major has come up, to be honest. So we're all waiting for the ADP and then obviously the FOMC. But we'll talk about that in a minute.
Yeah, no worries. Yeah, the ADP is coming up. Let's just take a look what the expectations are from that. On one calendar I've got, we're expecting. Oh, well, where's it going? There we go.
148.
Yeah, 148 is expected there. As you can see there, prior was 145. So, as usual, anything that's in the plus side over 100k is going to garner probably little reaction. Both here and in the NFP. But if there's a big variation or even a negative number, then we're going to get some a bit of volatility, I should think. And also later on this afternoon, we get the services ISM numbers dropping as well. So some decent data there. Keep an eye on the prices paid and the employment components there. That was a very strong reading last time in the prices paid number. And employment looking fairly decent as well. So just keep an eye on that. Again, big variations are going to play into last minute expectations for the Fed and for the NFP on Friday. So some of you might be waking up to a big turnaround in the dollar, largely led by yields as always. As Stel mentioned yesterday, banking worries rearing their ugly heads again, or its ugly head again, and that comes on top of everything else, the debt ceiling stuff, mentioned the banking stuff, global growth issues, geopolitics, Fed hikes. It's all seems to have come in the pot once again today, and we've seen a bit of a turnaround. Yields have been, as I say, leading there. As you can see in the US numbers, we've had a big, pretty decent drop in yields once again, moving in 20 pip clips sort of thing. Big moves for the bond market. US 10s as well, looking a bit ugly as well. And as you can see, this pretty much, the recent price action pretty much sums it up. We're just, flipping switches from one side of the market to the other. 1 minute we're looking good, next minute we're looking crap, then we're looking good again, then we're looking crap again. And that's been reflective in the price action here. We nearly got up to my 138 in dollar yen yesterday, and I was aiming up here for a short, both for a short term and to my core position. I wasn't around for a lot of the day yesterday due to some personal stuff, so I missed doing anything up at these highs. But I'm going to call that a first test and hold of that range top there at 138. So it's proven to be a bit of a sticky level there. Anyway, I know Kay had a bit of a trend line coming across these two highs to this point, but for me, it's really 138 because that's been the, as you can see going back, that's been the level going back quite some time. But either way, we got close but no cigar to that one. So as I say, a first test, and I'm calling that a confirmation of that. The pullback's probably been a bit steeper than I would have thought we would have got, particularly after where we were left after the Bank of Japan last week. And I'm wondering if maybe there was some month-end stuff in amongst the Bank of Japan stuff. Yesterday was the first full trading day of the month, and that's where it's pretty much stayed a turnaround after making those highs. So maybe there's some EOM stuff in there as well, or new month flows in there as well, or the end of month stuff washed out. But as Stel mentioned, those banking worries probably hitting things as well. So either way, the pendulum has swung again, and we're not looking as bullish as we were yesterday. Where can we go from here? Unless there's some news dropping before the Fed, perhaps we should look for a bit of consolidation. We've got some support in dollar yen down into 135.30s and the low 135s. It's been a former support and resistance area. As you can see, it was a bit of a break point towards the end of April. So that's the sort of area we're potentially going to be looking if this decent move down is going to hit somewhere where there's going to be trouble. It's maybe around this area here as we get into the Fed. When we get to the Fed, it's pretty much a coin flip. We know they're likely to hike by 25. We know they're likely to push the higher for longer. It's really going to be about, are we going to be close to a pause? And is that right now, or is that one more hike away, two more hikes away, or is it just an open door and they're not going to commit to pausing or continuing one way or another? So that's going to be the question. Even so, the market is still, as mentioned earlier, is still looking for this pivot later in the year. So again, coming into the Fed, I can't see any way where they can be super hawkish unless they're going to indicate rates are going to go higher than their current dot plot. At most, I see them just reinforcing what they're doing at the moment. We will be at rates at 5 to 5.25%, which is getting them close to their current ceiling. So maybe they only have a couple more hikes in the pipe. And the market is going to wait for that before it really gets stuck into this pivot trade again. So I don't really see any reasons why the dollar should rally significantly on the Fed, and that any rally is likely to be hit, particularly if the rest of the issues are still bubbling away, like the banking stuff. So that's going to be my base case going into tonight. I think a move back to 138 is potentially out of the question. given where we are now, 240, 250 pips away. I can't see the Fed moving us that much, but I'll be keeping an eye on it. If we get up there, I will be looking to add to my core short position. And on that, I'm happy with the hold. I'm happy to stay in the position. If we had broken 138, I would have been assessing the trade overall. It's a trade I've been in for quite some time. The carry is something I need to be concerned about, but as I have been doing, I've been trying to, when I've been trading short off here, I trade some for short term and I trade some to put in the slow cooker. So if I make profit on the short term stuff, it pays for the costs of the longer term position. Stel, you see anything for the dollar today in particular, or likely reaction?
Well, what worries me with the dollar is that we are still very close to the to massive support in the Dixie. So 100.80, we've been talking about that for a while. And can the Fed cause the dollar to break through? Of course they can. And I think today could be the day. Having said that, I find it difficult to see how they can be dovish enough to cause that, because let's remember, we are still pricing a good chunk of cuts by early next year, by January, February. And I'll tell you what, if it wasn't for these banking fears, I don't think they would even be considering, or the market would even be pricing this much of cuts. So yes, there is this big danger looming, and you know how this can escalate. We saw this in 2008. I remember I was trading it pretty actively back then, and it was scary. I'm not saying it's the same thing, far from it, at least not now, but it is a danger. And as long as that's the case, the Fed has always reason to be on the dovish side. But I just don't see how they can be that dovish to cause the dollar to just, fall below 100.80 and then to the abyss. So what do I think is going to happen today? They're going to hike 25. I think there's almost zero chance of them doing anything else. And they are going to leave the door open for everything, for pausing, for maybe data dependent if inflation remains sticky. That's what central banks do, and that's what they know how to do best, is being vague. And I think he is going to be vague because the situation is fluid. And you were talking about price action before, and how one day we remember, there's a banking crisis, the other day everything's nice and dandy. That shows signs of a market that's unsure of what's coming. And if I was the Fed chair, I would be very careful with the kind of message I send, because we are in difficult times, and it's a situation that we haven't seen in many years, quick rate hikes, and now we're starting to see the effects of those higher rates, and all the irresponsible risk taking is coming to the surface because when you have higher rates, you will find who was it, Buffett, who said that when the tide comes out, that's when you see who's been swimming naked. Well, I think that's what we are seeing now. So to summarize, and not to talk for 3 hours straight, I think the Fed will do 25. I think they will leave all doors open, and the market will probably take it slightly on the dovish side. I think that's what's going to happen. So the dollar will probably grind a little bit lower, but I think it will take a major event for the dollar to break through 100.80. And if that happens, look out below.
Yeah, I think there may be a greater chance of that happening because you look on the other side. What does the Fed have to say or do to get the dollar rallying significantly? And that's really only taking rates through their current ceiling, which I don't think anyone can expect them to do. And so if it ain't going to go up, if the dollar ain't going to go up on the Fed, it's only going to go one other way, and that's down. But like you say, is there going to be enough from the Fed? Are the pivoters are they just waiting for the Fed to confirm that there is a pause coming before they really start to pick up that baton on pricing rate cuts to the extremes that we know the market likes to go to? And if that is the case, they do pick up that pattern, then I can see the dollar getting a heavy whack post-Fed particularly if these banking worries continue to circulate and all the other negative stuff comes in. But then,
Yeah.
you know, like we say, we get a stonking ISM today, and probably the dollar's rallied into the Fed, and all the hawks start, you know, getting on the bandwagon. It's like we've been saying for a while now. You can't marry a position, you can't marry a bias. You've just got to trade between the numbers. So if you get a good ISM and the dollar rallies, and you think that the Fed can't do anything more hawkish than they are now, then you've got to think about a short or a fade of any dollar strength into the FOMC, or even over it, because there's so many things in the tank to play on, like the banking stuff, and that's going to reassert itself right after the Fed.
I know you're right regarding what the Fed has to do for the dollar to rally, and they basically have to be firm on inflation. And that's what they've been doing over the past year or so. You know, they've been reiterating that inflation is still high. We need to bring it under control. Are they going to be firmer now or more hawkish in the face of what's happening with banks and everything? I find it very difficult. So I agree with you. And if something can't go up, it will go down, but it can also go sideways.
Yeah. It can also go sideways. So there we have it. Today it's either going to go up, down, or sideways, and you've got yourself covered.
We've covered it.
For this, we've covered everything. Right. Thank you for coming to a flow show. See you tomorrow. But looking at the bigger picture and anything to do with the Fed, I always come back to yields, and I come back to this 2-year chart, because for me this is giving us a good horizon for where Fed rates are expected to go. And you can see this is the current midpoint here. Now that's going to go up 25 pips if all goes to plan. So we're going to go up. Let's see if I can nail it. 5.125. Oh, there we go. Oh, close enough. No, I blew it. So the Fed midpoint is going to go up there, which is above the highest we've been in yields. And yet look at where we're trading. We're trading below 4%. So the market is still not believing that the Fed are going to potentially get rates that high, and more so, they're not going to be able to keep them that high for long. You know, even the 1 year, you know, looking at the next 12 months, again, you know, the midpoint's going to be coming up to there, around there. Still we're below, and you know, we did have a little spike above, but we're not even up at 5.8% or 4.8%. We're not even at the midpoint now, let alone where we're going to be before. So the market is still distrustful of the Fed, and I really can't see that changing. And I do think that this pivot is going to pick up after this meeting, unless there's something shockingly hawkish, and all roads from that point to more pain for the dollar from here. Whether it's a straight line, whether it's a grind, who knows? As I say, we get to we have a Fed meeting that's seen as dovish, and the dollar sells off, and we get a 400k NFP print, and everyone turns the other way again. So you know, it's hard to get in a position and think, right, I'm going to ride this for a couple of weeks, because it can flip around. So we've got to be careful. If you've got in trades, if you've got profit, take some profit in case you get one of these flips. That's the best advice I can give to you today. Don't sit in a winning trade and not take anything and find it's done a 180 on you 2 days later and you've given it all back. At least put some in the bank. I'd rather have some in the bank and give back the rest than none in the bank and lose the position altogether, or be up a good chunk and give it all back. Looking at euro dollar, getting another move up towards them highs. Still got this big barrier up at 111, so we need to keep an eye on that over the Fed and whatever. But again, it potentially sets up for a decent bit of resistance area up here. You know, we're 60 odd pips away. Anything seen as dovish, we're going to get a test of that. But if it breaks, then I think we're going to be right on for a move to 112, potentially at a minimum. And that is a big fib level. It's the 61.8 of this whole big move here down to those lows. So I mean, it already looks like the trend is breaking with the break of the 50 fib, and we're finding support down towards it. So there's no reason to suggest that this trend is changing at all at the moment. And if we get a break of 111, we could be going higher, and then we might get up to the juicy 114.5, 115 area, which has been a big old level going way back. You can see there around the 115s. So that's going to be another massive level again if we get up there. But it's going to take a move above 111, 112 before we even start to think about that. If we get up there, I'll be interested in tapping that for shorts, at least on a first try, because as I say, big, huge level 115. Looking around some of the other grounds as well, Euro Sterling. Let's bring that down to a bit smaller. So yesterday got into the old zone that we've watched and has been on and off for ages and ages and ages. Found it support at the bottom of the zone and a decent rally up. Not sure why this has suddenly gone all perky. It's probably just a differential in volatility again between cable and the euro. Obviously, we've got the ECB coming up this week as well, so maybe some expectations for that. This line, it's not something I'm looking to trade. It's more just an indication for how the price is reacting at the moment, but it's banging its head up there. But that comes in right amid the 88, 20, 30 area that again has been one of these traffic zones that we've seen going back. Its support, its resistance, it chews around it, waffles around it. Get a move above there, and then we maybe take a look at the 88.60 again, another old traffic zone. We'll get to see if that's resistance once more, or if we've stepped up a bit to near this 75.80 area. Still far short of the 89 zone and the 89.20 area, which we're going to need a break off before we can start thinking about 90 again. I'm still in longs in this one. I didn't do anything down here. I'd prefer a move down to the low 87s, but then I might be worried about why we're going down there. So I'd have to judge the move at the time. But otherwise, we continue this sideways action, moving from pillar to post, bit of a consolidation phase going on. And I don't see anything changing in that, except maybe when we get to the Bank of England next week and whether they're going to recognise that inflation has been more sticky, and they're going to have to do a bit more than what they and everyone else is expecting on rates. I think next week, May meeting, I think it's also a monetary policy report meeting, so i.e. a press conference and all the latest forecasts, but that's for next week, and we'll check it out. Do chuck up in the comments if you've got anything you want us to talk about while I go waffling on. I see that Ali is short euro dollar at 110.35 with a 111.45 stop, 109.23 profit target. Also long euro yen. Okay, so you've got a bit of a cross play there. If you're short euros versus dollar, but long euros versus yen, you've got a bit of a cross dollar yen position there. I don't know if you look at things like that. I don't. I know Kay looks at the crossways a lot. I don't. I usually take each trade separately on its own merits, but you can keep an eye on if you've crossed up a position to know what the underlyings do. That can also give you an indication of which way things are going. But yes, throw up any other things you want us to talk about here. Still, you got anything? You got your charts handy? You want to have a look around? Anything?
Yep. I'll do that in the absence of the caveman.
The caveman.
Let me grab the charts. Caveman. Every time, man. Every time. So, I start with yields as always. 10-year US is starting to look a little bit dangerous to the downside. Again, the Fed is going to be driving this, but you could say this looks like a head and shoulders. And, there's a lot of debate about head and shoulders, whether they are continuation or reversal patterns. I think more often than not, you'll find that they are continuation patterns. I think Blake says the same thing. So, we are grinding around this area here. And, if this is the neckline, I think that calls it about 330 or 328. And anything below that, well, yeah, we go lower. That means that the Fed is about or ready to be cutting pretty quickly. But for now, yields are still, yes, we are lower a little bit from a couple of days ago, but we're still in this support zone, which is very, very important. And as far as I'm concerned, we haven't had a technical event yet. So as yields are not driving the market at the moment, and let's face it, the market is not doing that much at the moment. Let's look at the dollar. And the dollar, as mentioned before, is also the critical level. And the dollar and yields probably going to go the same way. If there's going to be an anticipation of the Fed cutting rates, that's going to make the dollar less attractive. So the Dixie will probably crash through this 1080 level and gaze straight into the abyss. And one of our friends actually asked, isn't that inflationary if the dollar weakens? Yes, it is. It is. So that is an automatic stabilizer, right? When you see rates dropping fast and a currency dropping fast, that's inflationary. That causes inflation, which means or is a contributing factor towards inflation, which means that the central bank then has to offset that by raising rates and making the currency more attractive. So so the Dixian rates and the 10 US are on the brink, close to, but not quite there yet. Stocks and risk in general, I still think the path of least resistance is higher, and this is in line with a weaker dollar and weaker or lower rates. I think that's the direction we're going to have. Obviously, if there is an escalation in the US regional banks, this is going to be negative for stocks. But if we seem to be avoiding a complete meltdown, then I still think we're going to see 4,200 and a break above here. Take out some stops, maybe even go towards 4,300, and then we reconsider. But I'm going to say this once again. If I was short stocks, obviously not for a day trade, if I was short stocks as a macro trade and, everything's overvalued and look at the world and, oh my God, rates have gone a lot higher and stocks have not done anything. Yes, you're right about all that. But if I was short stocks, I'd be very, very scared at the moment because they're not selling. And if something doesn't sell off, it usually means it's going to go higher. So be very careful. If you are short, you know exactly where you're wrong. Anywhere above 4,200, you will need to bail out, in my opinion. Okay, obviously you do whatever you want to do. Moving on to the pound. Well, cable still broken out of this channel. It is lingering around here, which is not great technically. I mean, what you want to see in these breakouts usually is breakout, a retest, okay, maybe a double retest, but then it really has to go. And it is going, but it's going slowly. So slightly worrying, but I am still bullish on this. I still think as long as we're above this, call it 123.5. I know it's 150 odd pips away, but as long as we're above here, I think this is bullish. So I will not change my view on that. The euro pound is a little bit different. It's still consolidating sideways for quite a few months now, over 6 months. And what do I think about this? I want to sell rallies. That's what I want to do. I think the pound will probably do okay in 2023 for the rest of the year. So I want to be selling rallies. Anything close to 90, I'm going to start scaling in shorts. Other FX pairs, the yen, I don't know. I hate the yen. I haven't traded it in a long time. It's I really want to short dollar yen or in general XXX yen pairs, but the Bank of Japan is still not pivoting and still not giving us the macro trigger that we want. Because when they do, indicate that we're going to start getting off the easing bandwagon and start tightening and doing what we need to do, I think this is going to move massively. I mean, I think 128 is going to come in a blink of an eye. And but now, still not touching this. The Norway pairs I really want to short. I had an unsuccessful short here on this fib on the Euro Norway, and both dollar Norway and Euro Norway I shorted. I got out at minus 0.5%, which was my stop. The dollar Norway is now edging towards this resistance trend line, but the kroner has been an absolute beast the other way, not in a good way. and I don't want to go against it yet. I might have a go if we get to 1084, but I was burned very recently, so I'm just gonna probably hold off now. Elsewhere, oil is, well, I've said it for quite a few days now. I don't want to trade oil. It's just way too volatile and crazy for me. We break below these lows. Yeah, I think I'm going to try and get on the stops here, because there will be stops below, but I'm not touching it. Metals, I still think are trading very, very well. And gold is still 4%-ish from its all-time highs. We're very close to this descending trend line resistance, the previous high. So we have a few levels. Okay, so first one is 2048, 2049, the previous high. Then we have a very close level around 2060. And then it's the all-time high. So we have three levels. What's the all-time high, actually? That's 2075 or something like that. So we are about $60 from the all-time highs. We have three big levels very close. So you could kind of say that there is a nice resistance confluence zone that you can play off. But man, I think this is going to go straight through at some point. Fed, again, later today could be the trigger. But anyway, you look at this. This was a very impulsive move, and I could barely call this a correction. I mean, it's just going sideways. Silver and platinum are a little bit different, because we have, again, I've said this again, sorry to repeat myself. We had a proper breakout of the channel. We are consolidating. I really thought we would retest, but we might not get there now. So is this a bear flag, bull flag? Probably. And then we go to infinity and beyond. Platinum is looking better, I think, technically, because it did actually retest and is bouncing. I know I probably haven't drawn it perfectly. So, however you draw this looks like a very nice retest and bounce. So I like platinum. I like platinum a lot. And I'm waiting for the Fed to see if I'm going to add a silver. I have two positions from way, way below. One was from 21.5. I mean, that's going swimmingly. And the other one was from, I think, just under 24. I need to check my papers again. But they're both well in the green. And that's why I have a little bit of a leeway to be experimenting with, failed experiments like the Norway short. But, I still think all these are going higher. Cryptos, difficult to say. I have a lot of difficulty to trade these, because my macro view is kind of non-existent. They are a risk proxy, definitely, most of the time. And this has been a very impulsive move higher, nice and orderly. Yes, we did have a couple of drops, but it's been higher lows. And as long as we stay above these lows at 27K, I think we are good, and it's still looking bullish. If we drop below 27K, I would get out of longs if you are long. Again, the Fed today, blah, 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 will lead the way. But hey, that rhymes. Yeah, I know, if you put a gun to my head, I would still buy this. We are testing we did test, and we're bouncing off the 50 DMA. It still looks bullish in my eyes, but these levels here, 27K, need to hold. Ethereum is similar, but is now again at this resistance zone, which has been important in the past. We broke above, came back below. Ethereum is trickier. I would concentrate on Bitcoin. It's trading a lot more technically, and it's closer to important levels as far as I'm concerned. What else to say? The CAD. Yeah, huge range here. Again, this is a looks like a very orderly consolidation phase after this move from 125 to 130, almost 140. In line with my bearish dollar view, medium-term view, I think this will eventually resolve to the upside, but we are currently right in the middle of no man's land. So I would wait for this to I resolve to the downside. I mean, I think the dollar is going to be weakening, so I think this will resolve to the downside. Even though at the moment it looks like a bullish consolidation, I think the dollar will be struggling in the future. But you have here your range. I know it's a wide range, but if you break below or above this, you should see continuation. So I would stay away from this for now. And Aussie, Kiwi, somebody asked before. This has been, I mean, look at that. 10-year consolidation. I know it's a big range. Actually, not that big. 15% from bottom to highs. But this has been just an absolute killer. If you're looking for the big move, this is not happening here. So what do I think about this? Well, it's in the middle of the range. I don't know. You want to trade it? About that, but I need to have a clear view, and I don't. What's happened? It's not updating. Anyway, that's there we go. That's all I had to say. So we wait for the Fed tonight for us, later today for you guys and gals, and hopefully they will give us something really nice and bring volatility to the market. Let's see.
Yep, hope so, mate. Hope so. You want to grab that back?
Yep.
Let's go.
Stell the rapper. Yeah, it rhymes, man. Everything I say rhymes. I'm a poet and I don't know it.
Can you see on screen okay there?
Yep.
Yep, cool. I was just having a quick look at Aussie Kiwi myself. Yeah, still mentioned, you look at the wide chart, we are in a big, huge, sideways action there. So you've got a decent range. You've got the patience to wait for either side of that. Again, we had the lesson why you need to check all your time frames to know where your big boundaries are. I mean, these are huge levels when you get these touches and holds. You might have to give them a bit of room when you get them, but if they do hold, then they can be absolutely amazing. I remember trading this one a few years ago because when we came down here, these areas, these levels here were some big, huge, let's get rid of that slot, big, huge multi-year test points, right in that 105s, massive level. One of those ones that always seems to have a saying things, and it can be decades between when you get the tests of them. So when you do get those are the big numbers you need to keep an eye on. But looking at the more shorter term, and there are a couple of levels around. There's a bit of, we've already seen it, a bit of a support coming into this 106.70, 106.5 area. So it's held, got a decent bounce. We're coming down, we've had a test and it's had a bit of a bounce so far. So these are your levels. For this one, if you want to be long, that's a level you lean on. If it breaks, then maybe you want to look to go the other way and to go with a break. If it breaks and you see a confirmation of the level breaking, then you've got some conviction to get into a short. We've got a bit of a trend line here, as you can see, coming in, a short-term one mixed with a longer-term one. Coming off this highs, we've run into trouble against that. So that gives you a bit of a range to play. And then you've got a bit more of a longer-term one, coming off that 2020 low. So again, it's an area, a level you look at that, okay, is the price going to do something there or not? So there's a good mix on the Aussie Kiwi chart of some longer term tech and some shorter term stuff. So if you can match those up, and if you get a confluence of long term mixing in with short term, I haven't even got my moving averages on there. Look at that, being lazy. then you've got places to trade. But as for direction, yeah, looking at the short-term picture, it's another case of we're up, we're down, we're up, we're down, we're up, we're down. Going to look at Aussie dollar as well, as been requested, and I'm afraid to say it's another one bang in the middle. I was, mentioned yesterday, looking for maybe a move down to this zone, low 65, 65 and a half, just to play a bit of a range play. And after the RBA, maybe a move up to 68, and we didn't even get a sniff of getting close to that. And here we are looking a bit softer again today, which might be a bit of a surprise given what the RBA's done. But as we saw with the RBNZ and the Kiwi, the rally in that lasted all of 5 minutes, and the same things happened here. So we're sort of reverting to, call it a mean area, but the support and resistance area, this 66, called it 60, 70 area, bit like cable at the 124.50. We just seem to come back here. So it does show we're sitting in the middle of the range. The market isn't sure what it wants to do. And when that gets like that, it sells the highs and it buys the dips, and we all come back to the middle until something changes. Similar for cable. We've had another move up. We've got to move up again. Last week pushed to get above the highs, but it's failed. We had a decent move down. The only thing I can say for cable is that it's keeping the trend. The series of lower highs keeps the upside in play, even though it's getting a bit messy. We had a high, we made a new high, couldn't hold it, all the way back down. Then we made a new high, couldn't hold it, all the way back down. So the trend up is still continuing. So until you start to see that break, until you start to see some of these lows starting to break initially, we're going to continue in this trend. And then if we do start to break those, it's then got to start taking on the bigger trade, the bigger trend as a whole. That's when you look at your fibs. So, we're now down at 122.85 for the 38.2, near the 122s for the 50. So it's got to do an awful lot to start breaking this trend. And the higher it goes, the higher these fibs go as well. But for now, cable, we've got the BOE next week. This one's going to react on what the Fed does, and then probably swing into the latter part of the week, start getting into expectations for the Bank of England. So trade this one really from the dollar side for now, until we're over the Fed and the ECB, and then the market switches its gaze to the Bank of England, and then all things pound will come to the fore. And a couple of others want to look at Guppy as well. Again, a bit of a mixture between some longer term tech and shorter term tech. So this, 169.90, call it 170. Again, another big historical line going back where we've had, 2015, 2014, where we've had the same things. More recently around this area here, back in 2022, last year, October. So we've confirmed the top side here. It's held, give or take, a couple of shekels, that prior high that we got, and we've seen a decent pullback. And where's it pulled back to? Pretty much around that 170 area. So if it's going to continue this move, if it's going to look to take out those highs, this is where it needs to hold initially. Below there, you might have some more minor down into the low 169s. But if it doesn't hold, then potentially we could head all the way back down here to the 165s. Again, this is going to be a follower of the Fed yields and yen until next week. But I think the good opportunity here is that if you get this one, or if we get yen looking well bid around the grounds, dollar yen is dropping, Guppy's dropping, euro yen's dropping, and we get to the Bank of England and they're a bit more hawkish, and you get a rally in this one. If that's counter to what all the other yen pairs are going, then maybe you've got a fade trade on your hand, because the wider yen play is going to override what the Bank of England do in the short-term noise. So think of it a bit like the RBA, RBNZ. You get a reaction if it's hawkish in the pound. Is it going to last? Pretty much no, if the rest of the yen pairs are dropping more significantly on bigger news. So those are the opportunities you want to look for, really, for things like that. Still mentioned oil. which yeah, it really is looking ugly, and oh, down in the 69s now. So we could be on for a move back to these lows. Got a bit of a level down here at 61.5. Called it maybe 62s. So that's the next spot to look for that. If we get under there, maybe we're heading down to the 50 fib down here, 54, 53 50s. Now you may notice my fib is not drawn on that big candle because that's the dodgy negative candle that we got that time when prices went negative. So when I get funny moves like that, things like the S&B where we don't know where the real lows are, I always take the first price action candle after it because that's a more solid place where volume was probably better than what was ever happening in here. That's why my fib isn't set to the bottom there. It's set to the next candle, which you can't really see. As I say, where the price action was probably a bit more solid after that event. So that's why I draw the fibs there. But what's also happening is it's doing for dollar CAD, seeing that rally again. This is one I'm also going to be keeping an eye on. Maybe we get another move up to that 138 area. Big solid level up there. Because again, this one is playing a bit of a wider range play, as you can see, between this trend line and this trend line. So we've been nudging around the middle. Didn't quite get a move up that I was hoping for before we came back down. This 133s is solid. I think up into this 138s, which is maybe meeting this trend line. If we get up there, maybe over the Fed, I'm going to be looking at that one for a potential technical play for a short, just to see if we hold that range and revert back to the middle again, as we've done many times before. Phew, lots of stuff going on.
Awesome.
Yeah, thank you very much, Dale. Good stuff from you. I hope you guys and girls are going to trade safe over the Fed. I want to hear your stories tomorrow. So, you know, let me know what you're doing. Talk to us on Twitter. You know the handle, ForexAnalytix, ForexFlow Live. You can even go and bug Stel on his Twitter handle as well if you want. But, let us know what you're doing. Then, obviously, in your chat, if you're in our chat room, then you know, squawk away, throw us up your charts, give us your plans. I want to hear you that you've made lots of pips tomorrow, and or the best case, I don't want to hear that you've lost any either. So, big night tonight. We'll have it covered as always at ForexAnalytix, and we shall pick up the pieces on the Flow Show tomorrow. So, thank you very much, one and all. Thank you, Stel, and Kay will be back tomorrow, and we go again. Have a great day, everybody.
Thank you, Ryan. Thanks, everybody.